All right, so I wanted to take a quick moment and talk about the proper process for retainer invoices, trust accounts, and why it matters. Give a little bit visual representation as well as maybe a little deeper dive into the financials and just show the reasons why this process matters and the proper process to do it. So first and foremost, in this process, a client comes on, they engage for services, you send out a retainer to ensure that you're paid for those services. The client pays the retainer, and then when the services are complete, that retainer gets applied for the services rendered. So how does all of this work in terms of invoicing and money and funds? So let's start with a simple example. We're just going to say client comes on, you send a retainer for $1,000. So you're going to send a retainer invoice for $1,000. Once that $1,000 is paid, those funds go into a trust account. Because retainer invoices aren't for earned income, it's not revenue. They're for client trust deposits. So you're receiving funds before any services are provided to ensure that you're paid for the services once they are provided. So from the bar perspective and from the IRS perspective, those funds have not yet been earned. They're being held by you in trust. So you, the business, the attorney, are holding the funds for the client on their behalf, but you don't technically, those funds are not technically yours. So it's technically a liability. Like you have a liability that offsets any cash that you receive. And we'll talk about that in a minute. Okay, so you've sent the invoice for $1,000. It's been paid. Those funds have been put into the trust account. As you can see here, what will happen is you will have on a balance sheet. So a balance sheet is a snapshot in time of the financial position of the business. It shows your assets, those things that you own, cash, investments, equipment, minus liabilities, which is your trust liabilities, your retainers, credit cards, any other debts you have. And then that equals your equity, what your actual invested interest in the business is. So when this $1,000 payment for the retainer was received, in essence, what's going to happen is your trust, I can't write that small, account will increase by $1,000, and a liability account, trust liability, will also increase by $1,000. So in essence, because it's assets minus liabilities, the difference is zero. That doesn't have to make a ton of sense. I just want to show you how it affects the financials. Okay, so we've received the retainer, we've deposited the retainer into our trust account. So once work is billed, it's billed separately. You create an invoice for the actual services now. So let's say the services are rendered and they come out to $1,000. That's what the service invoice will show. So if you have received the $1,000, now what you're going to do is you're going to take $1,000 from the trust account and pay this invoice on behalf of the client. Okay, so the invoice at $1,000, we just paid $1,000 from the trust account, from the funds the client had previously paid us, and now the invoice will show $0 due. So when the client receives this invoice, they'll show, well, $1,000 worth of services were provided, and that retainer payment that I sent, however many months ago or weeks ago, was used to pay for those services, so I owe $0. The reason that this matters is because now at this point, this $1,000 that's paid on this invoice will go into our operating account. So once that $1,000 goes from the trust account, pays the invoice, and goes to the operating account, that's now considered earned income. And we'll see that $1,000 right here as service revenue or with some type of revenue. And when that happens, then over here, so we'll call this step 1, and we'll call this step 2. What happens is your trust account will go down by $1,000, and your trust liability will go down by $1,000, but your operating account will go up by $1,000. Sorry for my messiness. Will go up by $1,000. Okay? So in the second example, this goes down, and this goes up by the $1,000. Now, the reason that this matters is because to the bar, they want to be able to clearly see and ensure that the clients clearly see how these funds were used. If we receive a retainer and just deposit it directly into the operating account, we violated the standard of trust. We violated our fiduciary responsibilities to hold those funds separate from our funds because we do not own those funds yet. So when we send this invoice and we receive payment, they want the IRS and Bar Association wants those funds separated from our business operating funds. So then, when the services are provided, they also want a clear representation sent to the client of how that retainer was used. So even though the client doesn't owe us any more money, we are required to show the client that those funds were applied to the services rendered. And then we also need all of this accounting process tracked here appropriately in our balance sheet, our profit and loss, and likely this account would actually be in a separate ledger with all this information tracking balances by client. So client A, money, client B, money, and then the total will equal this and this. So I hope this makes sense. Again, not trying to get super deep into the actual accounting process, but trying to show why it matters and what the difference is between a retainer invoice and a service invoice with the retainer applied. If you have any other questions or there's a certain part of this that doesn't make sense, feel free to ask and I'll try to clarify that for you.